edition of the Invest in GH webinar series. I'm your host, Prince Henry Dankwa. This webinar is proudly brought to you by Invest in GH. Invest in GH is the leading provider of financial news and education in Ghana. Our news, magazines, and more recently, webinars have been delivered to thousands of people in Ghana and beyond. Invest in GH started in 2015, and we currently host a website with over 5,000 subscribers, of which most of you here are a part of. And I want to say a big thank you to all of you who have joined us tonight. If you missed our previous webinar on how to buy stocks in Ghana, you can find it on our website and also on our Facebook and YouTube channels. This webinar is currently streaming live on our Facebook channel as well. So if you're unable to join us here or you know someone who is unable to join us, you can send the Facebook Live link, which is available in the chat session, to the friend of yours or whoever. Also, before we begin, I'd like to say that if during the course of the presentation you have any questions for our presenter, kindly direct your questions through the chat session here. Or for those of you joining us on Facebook, you can type your questions in the comment section. Tonight, we'll be discussing how to choose a mutual fund. How to choose a mutual fund. And our speaker is here with us. He's the head of Fidelity Securities Limited. That's the asset management subsidiary of Fidelity Bank. He is responsible for driving strategy and growth of the business. He has over 14 years of investment banking experience in portfolio management and financial planning. He holds an MBA in finance from the University of Leicester, an MSc in finance and investment from Brunel University. And he's a fellow of the Global Chartered Management Accountants. Ladies and gentlemen, please help me welcome Mr. Akwasi Adu-Boahene, our speaker for tonight. Mr. Boahene, you're welcome.
Thank you, Henry. Thank you very much. And thank you to you, Henry, Ellie, Eric, and the whole team at Invest in GH for the opportunity to share some knowledge on investments with specific reference to mutual funds. And then also good evening to all participants. So, like you rightly said, I'll share my screen and then begin the presentation.
Okay, all right. So over to you then.
Okay, so once I'm done, then I'll get back to you, Henry, then we can take it from there in terms of questions.
Okay, all right.
So thank you. Yeah, so just a minute, I'm sharing the screen and then. So like was rightly said, we're going to look at, this is our table of contents, and collective schemes belong to, I would say, a family of investment vehicles, which we normally term pooled investments. The whole concept is that we mobilize funds from either the public or maybe private investors. And then depending on the structure, these funds are invested to earn returns. So we'll speak briefly about them, and then we'll look at what collective schemes are. Under collective schemes, we have both mutual funds and unit trust. We'll discuss the difference and then also the similarities. We'll look at how they work and also look at how investors make money or earn returns. And what are some of the benefits of mutual funds? We'll be using mutual funds interchangeably, which, like I said, in terms of the concept is the same as unit trust, but the structure is slightly different, especially from a governance point of view. And then we'll look at what are the things to consider when selecting mutual funds. And then also, as an illustration, I'll just share with you features of the Fidelity Unit Trust, and then also contact information if you may want to engage us to more or less give you further clarification or details when it comes to managing money. So let's go straight to it. So pooled investment, basically, like I said, the concept is pooling funds together, collecting funds together, mobilizing funds together, and then the idea is that investors want to make returns and they are put in certain vehicles and then we can earn returns. So I'll look at them briefly. There are quite a number of them, but I think for our discussion, we'll look at these four. So let's look at hedge funds. Basically, hedge funds not everyone is not really open to everyone, but normally for sophisticated investors, they have a lot of money, they have understanding of investments. And what happens is that they tend to use a lot of strategies to earn high returns for those who are part of it. And it's normally for the short term. If you look at private equity, that is long term. You mobilize money from investors and then they are put in companies that are private. They are not publicly listed or trading, so that at least the managers can turn these firms around and then make some money for investors. So from the hedge fund and private fund perspective, private equity perspective, they more or less look at a group of investors, not everyone. So we'll safely say that look at private investors, for want of a better word. And then we'll then come to other vehicles or funds that will look at the public or everyone, open to everyone. Because normally the funds are very small to start, a little over maybe 100 Ghana or 100 Ghana cedis. So we'll look at exchange traded funds. Basically, these ones are used as stock agents, for example. So someone could set up a fund and then that fund will invest in certain stocks on the exchange that make up the index. And what happens is that ideally, the idea is that I should be able to buy every stock on the exchange, but it's not practical. So what happens is that once you buy into that particular fund, the fund will invest in some stocks that are in the index, and then it tracks the performance. And these funds are traded on the exchange. You can go in and out. And at every point in time, though theoretically we can calculate the price per unit, because it's also actively traded on the market, you could either sell it at a discount or at a premium to the theoretical price, which is actually calculated by the managers of the fund. Then we look at where we'll be talking more, which is, we tend to call them collective schemes, especially in Ghana, collective investment schemes, CIS, and there are two kinds, the mutual funds and then the unit trust. Because we talk about, maybe let me just talk briefly about them. The concept is the same. You mobilize funds from the public, then they invest in these funds. And then what happens is that at least once there's what we call a prospectus, something that guys will be investing the money. Once we invest the money, we earn returns and the returns are shared. The only difference between the two is that a mutual fund is set up as a company. It is a virtual company, but the directors are real. They are human beings who are acting as directors, but the company is virtual. But we can still safely say that though it's virtual, they are manufacturing or producing investments, if you should link it to a real company. So the idea is that the directors have to ensure that managers invest the fund in the right asset classes to ensure that they can earn returns. So you have a board of directors in place. These are registered to the regulator, and then the fund manager reports to them as to how well the scheme is doing. When it comes to unit trust, they are set up as a trust and then governed by a trustee, and then there's a body corporate, which is a trustee, which will oversee the activities of the fund manager. So the concept is the same, the structure is different, especially from the regulatory point of view. So I just go into details. So you look at collective schemes, like we've discussed before on the previous slide. You collect monies from individuals, it's put in a pool, invested by the fund manager according to the policy, what you know called investment policy guidelines as to where to invest money. And then as they invest money day in, day out, they generate returns, and these returns are passed on to investors or those who are actually owning shares or units of that particular scheme. And in return for putting your money there, you get, I would say, a portion of the assets of the particular fund. So on pro rata basis, it depends on the amount you put in over there. The more you put in over there, the more you can really make money. And then also, let me say this. As you invest in such vehicles, you are beneficiary owners, though not legal owners, in the sense that whatever fund they buy, the certificates are in the name of the fund. But then because you have certificates or units for that particular fund, you share in the assets of the fund. And then also the sponsor or the fund manager or the promoter, there's a fee that's charged for managing the assets. And this will be very clear in the prospectus, the document that spells out how the fund will operate. And like in Ghana, they operate as either a mutual fund or a unit trust. Now, this is how they work pictorially. So you can see investors over there, these two young men, they put their money in the pool, it goes into a bank account. The fund manager then invests the funds into securities, be it depending on the guidelines for that particular fund. It could be government securities, it could be bonds, it could be bills, it could be shares. And then as they generate returns, the returns are passed on to the investors and the cycle continues. As long as the fund is running, it continues. Whether there's a holiday or no holiday, returns are being earned on the portfolio. Now let's see how returns, they actually earn the returns from all sources. So from dividends, if they bought some shares, yeah, and dividends are paid, yes, it will go into the fund and then it's shared among investors in the fund. If they are what we call fixed income instruments like corporate bonds or treasury bills or government bonds, they pay coupons, they go into the fund, and then it's shared among members. That's one way. The other way is that as the funds are being managed, if it should happen that we sell some of the securities, maybe the opportunities, we sell some of the securities, we bought it at 10 cedis, it's now 12 cedis, we sell it, and then we make a gain. Maybe 2 cedis, it goes back into the fund, and then it's shared among investors. Or if you have, if you don't even sell it, and then day in and day out, because you bought very good securities, they are appreciated, it also goes into add to it. And I'll say that the regulator requires that you do a daily valuation, because day in people are coming in and out. So it's absolutely vital that valuation is done on a daily basis to ensure that at least the appropriate returns are accrued on investor accounts. Now let's look at some of the benefits of mutual funds. We are pooling monies together. Mine may be small, maybe 100 cedis, someone brings 1,000 cedis, another person brings maybe 10,000, 1 million, all is put together. And then per unit cost, you realize that when we go and then we want to buy securities, it's cheaper. Ideally, because the funds are also huge, brokers are always ready to provide information. If I go with 10 million or 20 million, it shouldn't happen, but a broker will always be ready to serve my needs, whether I need an investor information, research, and then also even when I'm negotiating for investments, returns, or maybe when I want to buy a particular security, because my funds are huge, why not? I can always go in there. And then because my funds are huge, it gives me that leverage. The other one is diversification. So what we are saying here is that because you pool funds and then your IPS or guidelines allows you to invest across assets, what happens is that you can spread funds across assets. And then what that means is that you take advantage of the diversification so that if one particular investment is not doing well, the other one tends to balance it. I also see here that, yes, it's true that we don't put all our eggs in one basket. We need to put them in different baskets, but there has to be some caution here. The baskets will have to be very good baskets. And COVID has taught us that, I'll give a typical example. Imagine that you have shares in maybe the oil in the oil stock. You bought some oil, the stocks of oil companies. You bought maybe other stock of maybe an airline. Before COVID, if oil prices go up, you might say that, well, oil prices have gone up. So at least what will happen is that we'll see some level of appreciation in the price of the oil company. And then the airline might suffer because operating costs might go up. If it's the reverse, if oil prices go down, you might say, oh, okay, well, now oil prices are down, so I'll see my airlines stop going up and the other way around. But you have COVID. The planes are not flying, they are grounded. The oil too, they can't be taken, demand is low. So do you may have diversified? COVID is teaching us that even when you diversify, look at it, ensure that at least in as much as you do, you diversify across assets, maybe look at the linkages among those industries you invest in, so that at least it cuts across. So you might not just look at diversification at the asset level, but maybe at a sectorial level and see how they are well connected, so that at least you try and look at assets that are negatively correlated, so that if these happen, at least it helps in stabilizing the returns on a portfolio. The other one is professional investment management. You have the thing is that these are managers who should be licensed by the Securities and Exchange Commission, so that at least they have the expertise to manage money. And when you're managing money, there are two things you're basically doing. You are allocating capital or allocating money. And you are doing two things, allocating it efficiently and effectively. Efficiently, all the manager has to do is that they have to make sure that they get the right returns when they go and negotiate. And then effectively, they have to invest in the right sectors that are growing or have the potential to grow, so that these things are happening, you can get your money back and get the returns as well. The other bit is regulatory oversight. As you all know, SEC is now very much involved when it comes to collective schemes. The process you go to get a license, reporting requirements, all this to protect the investor, which gives some level of comfort to the investor, irrespective of the funds they invest in. And it's also tax exempt. At least you enjoy, you don't pay tax on it, which I think is a good way to invest and then make money. So look at some few areas if we are to select mutual funds. The first one will be licensing, which is absolutely vital. You need to be sure that the fund you are investing is licensed by the regulator, so that when there are issues, at least you have avenues to address them. And then also briefly at the people who manage the money, the fund manager, that's a body corporate, and the people who are in there running the firm from the board and then the management level, and then key staff as well. And then also every fund has objectives. So we look at some funds and look at the objectives, and then at least we can take it from there. And also performance, which is a very tricky one, because when you go into a fund now, it gives you a guide of how well the fund has done, but then you also need to appreciate the fact that the fund manager has the capacity to invest funds across asset classes, earn you the money, and anytime you go to the fund manager, you get your money back with the needed or necessary returns. And also, one of the key things, your risk tolerance, which I think that we could also talk about it briefly, from two angles. The first one is your willingness to accept risk. So what we're saying is that you have the money, you have so much money. This investment you are doing is just a bit of your whole pot. So it's not that that's all you have, but you are just not inclined to seeing drop in your investments, because then you can't manage your expectations. So it's absolutely vital that at least you are very sure of what you are entering. And then when there are a few bumps along the way, you can easily appreciate it. And then maybe charges when you are running some of these. In terms of licensing, like I said, it should be licensed by the Securities and Exchange Commission. On their website, the funds are licensed, the rules that govern them, and then also any fund you want to buy always request for what we call the prospectus. It tells you how that fund will run, what are the expectations, charges, where will the assets be invested, in terms of reporting, what kind of services will I get? So it's all in there. So at least you can have a quick read through, which I believe that will be very helpful. As long as they are licensed, as you can see, it gives that protection to investors. It's very vital, absolutely vital that is done. And the other one is the fund manager. We are saying that any fund is as good as the people managing it. It's very important that you take a second look at the people who are managing it, right down from governance structure, from the board, and then management. They need to have the experience and expertise in managing it. The board provides that guidance. For example, Fidelity, we have a very strong board, a subsidiary, with support from the parent group. And then also the parent group should be very strong, having the deep pockets, like in that case, Fidelity. And then also commitment to the firm is absolutely important, that they are committed. I mean, the bank has very much supportive in driving our growth, selling our products to the branches, supporting us with expertise from IT, marketing, finance, and making us very stronger. So it's absolutely vital that you look at all these when you're picking a fund manager. As you can see, what the issues we have in the past has had to do with corporate governance issues, risk management culture. So it's important that if you have a firm that has a strong backing of a group, it gives you that level of confidence. So let's talk about some of the funds. We have what we call the money. Yeah, so the money market fund is a short-term fund. You basically invest in instruments that are less than a year. So T-bills, fixed deposits. And the whole idea is that it's for short-term needs. You probably are thinking of school fees in the next 3 or 4 months. You are thinking of maybe buy an asset, just mobilizing money to buy an asset. It could be for rent to be due in the next few months or so. So you could look at that. You could also look at what we call the balance fund. You could also look at what we call the balance fund. So with a balance fund, what happens is that it's a combination of both equity and then what we call the fixed income instrument. Equity will give you capital appreciation over a long period of time. Fixed income instruments will give you a steady growth of income. For example, we have the Fidelity Balance Trust, which does that. So you are getting both capital appreciation and then steady growth of income. The other bit is the equity fund. That one is for those who have the muscle, because with equities, there's a potential to make so much money. But at the same time, what can happen is that there might be some, I would say, temporary short-term losses on years. And then at times, it might frighten you a bit. But over the long term, you stand to gain. So we always tell people that you should know yourself. What's your attitude when it comes to risk, so that at least you pick the appropriate fund that suits your needs. The other bit is the fixed income fund, which invests across all fixed income instruments. Either it's a T-bill, either it's a bond, then basically normally from bonds, corporate bonds, or government bonds, or quasi-government bonds, or municipal bonds. And they will normally focus on what we call giving you a steady income over time, like we have in our case, the Fidelity Fixed Income Fund, which will look at all these bonds that guarantee a steady stream of income. The key thing here is that buying instruments that are of high asset quality, it's very important that it's done, because at the end of the day, you want to be able to get your money back when you go, and then you engage the managers of the fund. And we also have the real estate investment strategy, where the focus is on real estate, be it commercial, be it residential or industrial. But these are all the exciting products I know that will be coming up, especially the real estate trust. So these are things you need to always be mindful. Your investment objective, it's absolutely important that you have it at the back of it to be able to select the appropriate fund. So am I looking at capital appreciation? Am I looking at steady growth of income, or a combination of both? If it's capital appreciation, and then the equities will work for me. Maybe I'll look at the balance fund and maybe the equity fund. If I want a steady growth of income, then I know I'm looking at a fixed income fund, because I know that every time it will be adding on and adding and adding on. Whereas if I'm looking at just capital appreciation, or to some extent capital appreciation, it goes up and then there'll be bumps along the way and then picks up again. And then also, so I tell people that if it's, for example, your child's school fees or your child education in some many years to come, you look at the balance, because you know that maybe you are thinking of 10 years, 5 years, 10 years. So at least even when there are bumps over a long period of time, you make so much money. But if, for example, you are not used to, money is going down, up and down, then maybe probably the fixed income will suit your needs. And then also investment horizon, how long do you hope to keep the money? Is it a year? Is it 2 years? Is it 3 years? Of course, if it's more than a year, then we are thinking of either the fixed income fund or the balance fund. If it's under 1 year, we could look at other funds, maybe the money market fund and all that. But these are conversations advisors can help you discuss, which I believe will be very helpful to you. The other bit is a fund valuation process, which is also very important. Like I said, every day you have to value the fund. People are coming in. I need to know how much it will cost me if I should come in. I need to know how much it will cost me when I'm exiting. So every day the fund has to be valued, and not in Excel. You need a very good system that can do that, because monies are coming trickling every day now and then. You need a system that does that, so that at least whenever you come out and see that this is the price of the unit, it is, we all know that it's fair to all those who are now subscribing to the fund or exiting. So valuation should also be according to global standards. It should be time weighted. It should look at the time, it should wait according to the time money comes in, not because the money is big. Because else what will happen that it will defeat the whole purpose. It means that when my money is big, I'll take a big portion of the interest that's earned. But if it's time weighted, if it's weighted by time, it doesn't matter how much my money is equitable and fair to all parties involved. So, and like we said, because every time monies are coming, you're investing in so many asset classes. There'll be corporate actions. They are paying coupons here. Dividends are here. Is there a system that can really, really ensure that at least they are all accounted for? Because like I said, it will reflect in the value of the fund on a daily basis. Now, performance. Performance does three things. One, it will tell us how the fund has performed. Two, why did they perform that way? Three, how can we improve it? So it's important that when you are buying funds, you are very much aware, how did the fund perform? Why did it perform that way? How can we perform? So when there are annual general meetings, you have to attend them. You make sure that you don't buy and then just put the certificate somewhere. You are always involved, and then even questioning the advisors and fund managers why they take certain decisions, which I believe that will go a long way to protect your investment. So it's important that we look at returns. I'm hoping that as our industry, so we are looking at how does it compare with other funds is very important. How does it compare with its own benchmark so that you can decide whether to invest or not. Now our industry is developing. Now we've looked at one side of just performance, which is return. I'm sure, I know that we had about a year ago, the regulator talked about it. We'll start even looking at another component of it, which is the risk aspect. So that we start looking at performance, not just from a return perspective, but return per unit of risk. So that if I say, so you think of it this way, I manage your money for you. Today is 10%. The following day is 20. The next day is 5%. And compare another one that today the return is 15. The following year is 16. The other time is 14. When the risk is just what we say departure around your expectation, the return you expect to get. If it's very close, you can plan. If it's not, and we are all over the place, it means I can't even plan. You work with 10 cities thinking that the next time to be 12. You go there and then it's 5 cities or 7 cities. So as the industry develops, return performance will be looked at both from the return and the risk perspective. And that's why a fund manager should have a very good system in-house to be able to calculate both. So that not just is 2 or 3%, but how does this measure with the risk, the person to ensure that they make that particular judgment. Now the charges, normally when you pick a fund manager's prospectus, it's very clear. You look at it and then they tell you, oh, the management fees, and the management fees, which is on the funds and the management. And some will say they will charge what we call front load fee when you are signing on. And some also charge when we are exiting, backload fees, which are graduated, yes. But it depends on the scheme you have. We have 2 schemes, the Fidelity Fixed Income Trust and the Fidelity Balance Trust. We believe that whether it's front or exit or sideways, there are no charges. So no front load, no charges, and then no back load or exit charges as well, just to let you know. This is just an illustration that we have to, just an illustration. So for example, in our case, the Fidelity Fixed Income Fund, the initial amount is 100 cedis, then you can top up 10 cedis, and then anytime you want it, it's not like you have to keep the money for 2 years or 3 years or 4 years. Anytime you want the money, you can come for it. No one stops you. There are no exit or entry fees, as you can see. And then this one provides a steady stream of income. And then these are the Q&As, you see it over there, who can invest. Individuals, institutions, groups. It's a way to build steady income over a period of time. So how does it work? We pull funds together, and then when we pull together, we invest across asset classes that of high quality. And then where can you start? You can either go to the branches and then get the forms and complete, or download it on our website, complete, and then you send it to us, and then off you go. We can start. I think once we share it, you can see all the details over there. These are some of the benefits: diversification across other asset classes. You have access to professional management. Anytime you want your money, you can get it, and then also you can build wealth as well. And then the other one we had is the balance, which look as both equity and then fixed income as well, so that I can benefit from capital appreciation, and then also the steady growth of income from the fixed income instrument as well. And this is our parent. We have a very strong parent, a tier 1 bank, very strong local bank, very strong out there. And over the years, like I said, when it comes to banking, they play a key role, supporting major projects, advising government from ESLA, and also when it comes to commercial bank, the retail side, we are everywhere, over 75 branches. So, and then the strategy is built on a value-added service that will bring excellence. Our focus on excellence, integrity, passion, we are all there. And as a daughter, FSL, I mean, you follow your parents. We exhibit all these as well in whatever we do. And we are licensed by SEC and the MPRA. We are a leading firm. And the Ghana Accountancy and Finance Award, they did awards, I think 2018 and 19, we won the Fund Manager Award of the Year, and 2019, the Pension Fund Award of the Year. So anytime we are managing money, we are there, we can manage, be it pension, non-pension, endowment, individual, institutional, we can help and travel with you along the journey and then help you build value and make money. Your money has to travel to the future. How will it travel? Inflation is acting as portals along the way. We can help you ensure that you overcome all that. And then over so many years, you get your money, and then you become so excited. How can you contact us? Our website is there, www.fidelitysecuritiesLimited.com.gh. We also have the bank website there to get banking products, www.fidelitybank.com.gh. And there's a mobile number you can call anytime you need assistance. I'll end by saying that, yes, we've talked about mutual fund, which is a way of pooling funds together to invest. The time to invest is now. We don't know what will happen in the future. Let's position ourselves properly so that we can deal with things that will happen in the future, be it for our pension, for our kids' school fees, or anything that may come up that we may never know. So thank you for your time. And I will now hand over to Henry, who will take it from there. Thank you very much.
Thank you very much, Mr. Boahene. We appreciate your presentation. I think we've learned a lot, and some of us, a few people have a few questions for you, so we'll go through them right now. The first one is from Alexis. He says, please, I want my portfolio to be managed by a fiduciary instead of a fund manager or a stockbroker. Will I get one in Ghana? He's referring to the fiduciary.
I think that it's more of a structure. Let me put it this way. Let's look at Ghana, for example. If I look at pensions, our trustees play that role. You know, pension funds, so we have trustees who hold assets in trust for contributors or investors. And then fund managers, so this is how it works. So, and fund managers then provide advisory as where the funds will be invested. So I think that what you can do for now is that the vehicles are there. We have trustees who do that, they hold assets in trust for individuals. And then these trustees will appoint people like us as fund managers or advisors who invest funds and then create the needed value for you. And that gives you the level of comfort, because don't forget that I'm not related to the trustee in any way. My family is also related to the trustee. So there's that independence. So we have the structure in place. There are trustees who can help holding the asset in trust for you, who then appoint advisors like us to manage the funds for you.
Okay, all right, thank you. Another one from Osei says that I invested in First Fund Mutual Fund, but now SEC has closed down First Fund. Does it mean I've lost my investment?
No, you haven't. You know, this is what happens. The fund is separate from the fund manager. So the first fund had board of directors, and I'm sure they will start engaging you. They will write you. They have board of directors who are independent from the fund manager. So though First Bank may have lost their license, the fund will still be operating. But I know SEC has now appointed new fund managers for the schemes. So I think there's a process going on, reconciliation going on. What will happen? Where are the assets? That's the key thing. So the key thing is not First Bank going down or losing the license, but where have these assets been invested? So I think that we can't answer the question now. What we can say is that I know they've appointed a new fund manager. So all you can do is that, and I'm sure they'll be contacting you. And I'm sure no matter what happens, that they'll have an emergency meeting and then discuss with you where the assets are. At that point, then at least we know that maybe you may have to wait a while to get your money. So the issue is that your funds hasn't gone bad because First Bank has lost the license. But the issue is that where are the assets? It's a process that is ongoing. Once the new fund managers engage you and then discuss with you where the assets are, then you might take it from there. So that's how I'll put it here.
Okay. We have a question from Ampa. He raised his hand. So Ampa, Nathaniel Ampa, you can ask. Yeah.
Good evening, Mr. Boahene, once again. Please, on the fees and charges, when you are making the submission, you're silent on that. Sometimes when you approach the instrument, also invest the instrument, like they'll be very silent on the fees and the charges. So it was later, maybe after you getting your financial statement, that there are fees, there are lows, there are this ABCD. What will you do?
I think that, you see, if you realize, normally when you complete the forms, you sign. You know, there's a place you take terms and conditions, you sign all those bits, and then you sign. I would say that for management fee, it's very clear. You see there that maybe it's 0.5 per quarter in our case, or whatever the rate is very clear. What you need to be mindful is that, are there other charges? That is maybe when you are signing on, which we normally call the front load fees, or exit charges. When you exit, there are some funds will tell that, okay, if you save that for the first year, the charge may be 3%. For the second year, the charge is 2%. For the third year, it's 3%. Because you have signed, you know, on the back, terms and conditions you signed, then it becomes binding. So I'll encourage that before you sign on, the prospectus, which will be on the website of every promoter, can you read through the fees and charges section to be sure? And then also when you are managing, when you are also going to buy, look for what we call the expense ratio, which is basically the expenses on the fund over the value of the fund. So that expenses, let's say management fees, which one is easy for you to know, but then there could be other charges, administrative. Make sure you understand, or it's very clear when you're signing on, what are your other charges apart from management fee? Is there a front load? Is there a back load? Are there any other administrative charges? The law requires that it should be very clear in your prospectus. So I believe that when you take the prospectus, maybe I'm sure when you open the first page, you see all the table of contents, you look for where charges are, and then please be very clear, and also always engage the advisors to be sure what the charges are, so that at least once you go in there, it doesn't become a problem.
Okay, thank you very much. We have another one from Paul. It says that, how do you check the background and reliability of fund managers before you engage with them?
Oh, okay. I think the regulator is one. You know, you have a regulator who knows how well we are doing, because that's a very good check, the regulator. The second one is that find a way of, you know, normally the promoters or sponsors will have clients, those they deal with. You may know, find a way of also getting a second opinion from clients in terms of the service, especially when they want to withdraw. You know what I mean? Because when you want to, especially when they want to withdraw. So what are their experiences? Does it delay? Do they go through very difficult circumstances or hardships when they are withdrawing? So I think first one is the regulator. And secondly, kindly check from other clients, because they'll show it to you, these are clients A, B, C, D, and E. Try and then find out from clients to see how well they are doing, especially when they have to pay your money back. That could be a good guide. And then also the other bit is that maybe you read about them and see whether it's consistent with what they do on their website and all that. Yeah.
Okay, thank you. We have another one from Marina. Marina wants to know how someone in the diaspora, as like someone outside the country, can invest in mutual funds in Ghana.
Oh, okay. I think in our case, for example, maybe I can just share that with her. I can share that for others. So in our case, for example, on the website, the forms are there. For now, what we do is that those who have invested in the funds, they download the forms, they complete it, and for now, they scan the forms to us. We follow up, and then we get the other particulars, the ID, and then the picture, and then we are good to go. We tell them how they can pay money into the account. The others who are clients of the bank, if they have an app, Fidelity app, they can use that to pay into the collections account as well. So yeah, there are venues for now. I think that's what is that for those in the diaspora.
Okay, I think we have a common question going through here, different people. So I'll just rephrase it so that you get it. Okay, so they want to know, let's say you have a starting capital of 1,000 cedis, right?
Okay.
And you want to invest in a mutual fund. They want to know what the returns will be on the various categories of funds. That's like the balance, the fixed income, and then the equity funds. And then if you classify that as, let's say, the interest on your investments or something, as compared to a fixed deposit.
Okay, so let me get so typically for T-bills are very safe, very, very safe. So if you are looking at, you get in the region of 14.8, 0.9 for T-bills, yes. Fixed deposits will slightly go around 15%. These are just averages. Our market is it's a free market, buy and sell. So these are just averages. Mutual funds on the average, now we are looking at around 17%, 16.5 to 17% net of fees. That's for the fixed income, around 17%. Yes, in that case, around 17.5, thereabouts. It doesn't mean that it's 17 for life, or it could be 18, it could be 15, it could be 16, but almost every time it's going up. Unlike maybe a fixed deposit, which will tell you that for the next 6 months, you are earning maybe 15%. When it comes to investment, like maybe the fixed income, like in our case, maybe you're earning around 17, 17.5. But there are times it might get to 16.5. There are times it might get to 18.5. Good news is that it's just going up, but maybe the pace might be different depending on market conditions. If rates come down, they will all come down as well. So I tell people that when it comes to investments, it's always about return expectation, the average, as to say. The law does not allow you to go and tell that I'll give you 3 or 4%. That's what we did initially. We operated like a bank, and then some were heavily affected. So I'll say that in terms of return expectations for now, hovering around 17, 17.5, and at times around 16.5 for the fixed income. The balance on no equities, the markets have been a bit slow of late. So for equity funds, they are not exciting now. Initially, I can tell that at the beginning of the year, we're looking at 20, 21. Now you're looking at under 6-8%. But like I said, if you're looking at it over a long period of time, even if there are bumps, you tend to make money. So I think in brief, that's what I'll do. But it would be nice if you also engage advisors. Advisors will sit down with you, do various scenarios, all the assets. If you put maybe 1,000, 400, 200 here, they can play with it in Excel and say, oh no, what's your expectation? It's 16. So no, let's vary. Let's keep varying till we get some sort of an average that suits or meets your expectations.
Okay, thank you. I'm hoping all those who asked those questions have had their questions answered. We have another one which says that, okay, someone wants to know if they can divert their SNITs or pensions contributions to a mutual fund. Are you, are mutual fund managers, giving the mandates legally to manage pension funds? That's what the person wants.
The question. Let me put it this way. I beg you, if it's law, not what is going to SNIT to, what's going to SNIT is untouchable. So let me put it this way. So pension, pension has been restructured in our country. There's a first year which goes to SNIT. It can't be diverted. By law, it goes to SNIT. It can't be diverted. But there's also a second tier. That's your 5%. That one, it goes to, if your firm has appointed a trustee. We have licensed trustees by the National Pensions and Regulatory Authority who have the mandate to more or less oversee the management of the second tier. So once your company has signed on to a trustee, what happens is that your funds go there, and then they in turn appoint advisors like us, pension fund managers, and then we invest the money. On the other side, you can go to them and do your own private investment in addition to the SNIT, what they call personal pension plan. Yes, we can also do for you. That would even a fund manager like us can also do as well. But that's the structure. We can't take the pension, the SNIT money. Hey, for the SNIT money, by law, it has to go there. So Henry, that's
all right. So there's a follow-up to your response to investments by foreigners. So someone else wants to know that, apart from downloading the form and submitting it, how do you continue with the relationship with your foreign investors? Do you have a virtual communication with them? And then how would they invest? Would they have to invest in foreign currency, or they would have to convert their funds to the Ghana cedi?
For investment, they have to convert the Ghana cedi. I mean, it has some implications. You need to go through a process, because don't forget that if you look at it from the macro level, if you are investing in currencies throughout, it might create a problem. So it has to be in cedis. For now, what happens is that because we are part of a bank, a group, what happens is that the platforms are there. If, for example, I'm a Fidelity client and I have the app, and then I want to easily pay. It's very easy. I can do payments through that because the account, Fidelity has one of the collection accounts. So that makes it easier for them to do that. And then also monthly, they do send statements. We send statements to all our clients, at least to know how well the funds are doing. That is the stage now. But what we are trying to work on is the fact that time will come that it might even be less than the monthly, weekly. But normally investments, you want to see return after a period. So our communication is normally sending investments, running investment or statements to our clients on a monthly basis. And then also we have all the channels, either the number, the email, where they can always engage us. And then also at times we also pick feedback from them using these channels, email, the website, and then the other avenues are even working with our bank as well to pick some sort of feedback from our clients and then find a way of serving them better.
Okay. Marina wants to know the difference between mutual funds, bonds, and endowment funds.
Oh, okay. Okay. So a bond is a security. A security is just what you're saying is that it's a paper that you've given to someone. It's a paper that someone has given to you. You give your money to someone, and then he's also giving you a paper to show that indeed you gave him this money on these terms. So let's say a corporate bond. Let's say a company A wants money from you. So he takes your money. He gives you a paper, and it spells on the paper how long it will be, whether it's 2 years or 3 years. What is the rate? What are other terms and conditions? So that is a bond, it's a security. And the mutual fund is a vehicle that collects money and invests in these securities like the bond. So the bond is a security, the mutual fund is a vehicle, or we call a pooled investment, that mobilizes money from people, and then we invest in what we call some of these securities I've explained. An endowment fund, normally others call them permanent capital vehicles. They are normally, they are charities. The whole idea is that we mobilize money for a cause, maybe your year group, whether it's a school year group, or so what that means that there's an objective. You want to build a science block, or you want to help the school in terms of developing the place. So what you do is that you try and mobilize funds for that cause. And normally with endowment funds, there's a spending policy. maybe we say that we only spend the interest on the money. We never touch the principal. And there's also an investment policy where we invest the money. So I think that the difference is that a bond, I said, is a security, a paper that shows that you've invested in a company. It could be government or a company, showing that the terms are fixed. Mutual fund is a vehicle whereby you pool money together and invest in these securities like bond. An endowment fund is a charity. The focus is on, like I said, as an example, you are trying to help, it could be a school, a hospital, trying to raise money for a cause, whereby they are guided by a spending policy and then an investment policy guidelines. Yeah.
Okay. Someone wants to know if you give out your slides after the presentation.
Oh, why not? Yes, why not? We'll do that. Yes.
Okay. All right.
And we also want to know whether they will come and invest with us.
Okay. I'm sure they will collectively answer perfectly. Francis also wants you to throw more light on the tax exemption part in investing in mutual funds and unit trusts, and if it's a constitutional thing for fund managers to do.
Oh, okay. I think some few years back, it became a big thing. It was the idea was that they would tax it. Now, let me explain. So when, in our case, our funds, when we invest and then there are no liabilities to it. No, normally when I'm managing a fund, you want to know the net asset value, which is value on the assets minus any liabilities. If it's a company, you know, when you prepare accounts, income, or you prepare all that, and then the 25%, you hit it on it. When we prepare accounts for mutual funds, you don't pay tax on that bit. So all those gains come back to you. It's a way of encouraging people to save. If we were taxed, like they will hit us. Because remember I said that they are like virtual companies. Yes, in this case, instead of producing goods and services, they are producing investments. So if they are virtual companies, then they should be treated like companies. They should pay tax, in quotes. But in this case, what we are saying is that when we prepare accounts for the mutual funds and all that, yes, they are never taxed. It's not part of the liabilities of that is accompanying the fund. So that it means that all that reflects in your income or your gains. So I just encourage you to save more and build for the future, or build wealth for the future.
Okay, thank you very much. We have another one from Ade. Ade wants to know, is there any investment package with a compounding gain?
Okay. Normally, investments it's all the compounding effect, and I explain all the investment we are talking about. So let's say I buy a 6 month. Let's use this example. I buy maybe a government bond, or maybe a T-bill. This is a simple one, T-bill, 1,000 cedis. And then every day, whether holidays or no holidays, I'm earning interest. Let's say that I'm supposed to earn 10 cedis at the end of 6 months. So at the end of 100 cedis, makes it simple. I put in 1,000. At the end of 6 months is 1,100. When I invest it again, now interest is going to earn on what? 1,001, not 1,000 again. So you see the effect. It will be high, compounding, interest upon interest. So now it's interest on the principal and then interest on interest. So by virtue of investments, it's compounded. And you see it more if you save for a very long time. If it's a short time, you say, but I just invested this money, I'm not even seeing anything. Yes, you see anything. It's rather over a long period of time, you see the power of compounding. So yes, by nature of it's already compound interest, but you need to allow time and space to benefit from the power of compounding.
Okay, all right, thank you. Osei wants you to throw more light on how to redeem your funds from Fidelity Fixed Income Fund, and then also how long it will take for you for your withdrawal process. How long the withdrawal process takes.
Okay. So it's within 3 days. So what that means, yeah, you download the withdrawal, or if you want to write a letter, but you download the withdrawal form, because you can't tell everyone that, especially you have to make sure you fill a withdrawal form. You complete a withdrawal form or download, walk into any branch, you give it to them, it will be scanned to us, or you can come to our office and then they process it. And now we don't write checks. So once we are part of a bank, once you do, the process starts, and then the account is credited. So it's within 3 days. But we encourage that you bring it a bit early so that at least they can start the process on time. If you're having issues, let us know. You know, we've put our contact, our contact details there. If you need a clarification, always call us and then we will be readily available to assist and help.
There's a follow-up to that. Can the person withdraw through mobile money?
Oh yes, you can. What happens is that I would say this is what we normally do. When we want to pay, you need to let us know how do we pay you. Of course, we didn't encourage checks. No, we've all stopped checks. So normally people use the account. They'll tell you they'll transfer money to account A, B, C, D. If you want that to you through Momo, let us know so that we can do that. We want to make life as simple as possible and convenient as possible for you.
All right, thank you. Someone wants to ask, is it advisable to invest in mutual funds with my client's funds as a contractor?
Well, I think that as a client, if you say client funds, I need to understand what you mean by client funds. Oh yes,
yeah.
It has to be a fixed income one. The fixed income one. Don't do the balance and the equity. Because from what I see, a steady income is key over here. We don't want the point whereby you may have to go and use the money for a project and then we start explaining, no, the market is down, wait for some time, and the industry is down. No. So if you are doing that, it has to be the fixed income one, steady. So the thing is growing steadily, just building. But I don't want a situation whereby it goes up and down. Maybe the time the clients want the money, the market is down and he may not have the patience. So yes, you could invest in them, but it has to be the fixed income ones. So that at least that gives you some level of leverage. Yeah.
Okay. Nanasafo wants to know, how do mutual funds front end fees and what is the logic behind that?
How do mutual funds?
What is the logic behind front and end fees for mutual funds?
Oh, I think when you read, you see, one of the key things when it comes to managing funds is distribution. When I say distribution, no, they need to get people to go out there and then be marketing the product. That's what I say. Because we don't charge it, I'm not sure, but the understanding is that it costs money to mobilize. It costs money to mobilize. So at least one of the ways is that at least you could support that. The other bit is that there's been argument that, well, you see, the front load, for example, they are saying that, look, you need to keep the money for a while. But then if we are not benefiting, don't forget that they earn fees on the funds and the management. So if maybe, let's say you bring 1,000, yes, we invested. After 1 month, you come for the 1,000. So if after 2 months, I'm doing valuation or calculating my fees, that 1,000 is out. So at least it's a way of earning fees, and at least I know that even if you come for it within 2 or 3 weeks, at least I'll cover for it. But normally they'll say that distribution cost and then some of these things. But like I said, yes, some of us don't charge like us. So because like I said, you think about it, why do I need to charge that? But it depends on every person. But we believe that we should rather look at how we can make the processes easier and simple for everyone so that it's a situation for all.
Okay, thank you very much. Livingston wants to know, apart from Fidelity mutual funds, who are your competitors?
Oh, so we have EDC is there, EcoBank is there, Stanley is there, and then who again? HFC. Yeah. Oh, there are a lot of that over 40, but it depends on the objective. Some are money market, some are fixed income, some are balanced, depending on the one you want. Yes.
Okay. All right.
I know that I have to talk of mine. I'm confident in mine, so I can only. It's
exactly.
just fair I do that.
Yes.
There are other ones as well, but just to let you know. Yeah.
Okay. There's a question from me. I want to know, how would you rate a fund manager? How would you rate a fund manager? And currently, which fund managers do you rate?
How will I rate?
Yes.
In terms of what?
In terms of the best fund managers.
Oh, the best fund manager. Okay, I'll leave this to you. Out of respect, I'll tell her how I'll rate, and I'll leave that to you to do the rating.
Okay.
I'll look at it from a balance sheet perspective. So maybe look at the fund size, that is one, balance sheet perspective. I also look at it from a return perspective. What are the kind of returns they are earning? Because don't forget that if you are growing, we need to know that it's because you are doing well, you are earning, you are out there making money for clients, not because people want to pump money in. That's one. The other one is that I also look at the, if I put it, the efficiency. So I'll look at how well you manage costs as a business. Because don't forget that if I'm struggling, there's a tendency that you, the client, will suffer. So efficiency, your cost to income, I may have to also look at it as well. And then also, one of the key things we tend to ignore is how solid the owners of the business are. Do they have the financial capacity? That's one. And do they have the commitment to ensure that at least they are going to support the firm? Because you need to invest in systems, human capacity to ensure that you build the business sustainably. Okay. So a lot goes into it. But like I said, I'll just give you the indicators and I'll leave that to you to do the judgment yourself.
Okay. Income wants to ask a question.
Okay.
Income, kindly unmute your audio so that you join us.
Hello, sir. Good evening.
Good evening.
Thank you for the opportunity and thank you for the education you are giving us.
Thank you very much, Mr. Income.
I want to find out, fund managers charge management fees.
Yes, please.
And that happens irrespective of the performance of the fund. I sometimes find it difficult to understand because you have to, I'm investing for you to add value to my money. Yeah. And here is the case, you don't perform and yet you charge the fees. Can you say something about that?
Okay, so when it comes to fee, I believe that it has to be equitable to both parties. With certain funds, what they do is that there's a mixture. So you'd have, for example, a flat fee. Because look, you need to buy a system. Maybe, for example, most fund managers who have bought systems, very good systems, they cost about 1 million Ghana cedis. And then these systems will ensure that they value the fund on a daily basis. They ensure that, and also you have expertise who have the skills in selecting investment to ensure that your monies are paid back. So what they do is that there are two things. So they will have some sort of a flat fee that accounts for running the fund, and then a performance incentive fee, which is maybe if you meet X amount, I'll pay you this. If you meet Y amount, I'll pay you this. Okay. So I think that if the fund manager should work and not charge at all, I'm wondering how that really works. That maybe we charge at all for managing the fund. I think that what you may have to look at is the fact that if there's a combination of both, one that will ensure that they tend to cover the cost, and then don't forget, once they have money, then they can invest in proper system for you and ensure that they invest your money well for you. They can recruit the right people who have the expertise. You can have the right systems to ensure that your funds are very much safe, because a fund is as good as the people managing it. Our business is the service they are selling, is expertise. So if you want a very good expertise, you invest in these systems, and then as a business, you need to at least cover these costs and ensure that I can give the best to your client. So I think it's a win-win situation for both parties, both for the client to ensure that they have very good service, and then the business is sustainable. Because if the business is going very well, it means that anytime you want your money, you can always go back for your money. But like I said, you could also look at some of the structures. You could look at a blend. Maybe there's a fixed fee and then also there's a performance fee. But for mutual funds, for simplicity, it's normally a percentage of the AUM. And then normally, like we said, now most mutual funds, they are around 70. And if they are charging you, and that's after fees, so some of them after fees. So if after fees it's still 70 or 16.5, it's still better than an FD, which may be 14.5 or something. So I understand that, yes, it's something that has to be looked at, but maybe let's also look at the kind of returns we are getting on the investments if we're doing it compared to if we're doing it on our own. So that's a win-win situation for both, very equitable, both for the fund manager and the investor as well.
Okay, thank you. We still have a couple of questions. So John Fia wants to know, after the funds have been left with the fund manager for some time, can the proceeds be withdrawn monthly?
Oh, when it comes to withdrawal, like I said, with the mutual funds, it's not close. When you say close funds, maybe you can withdraw at a certain point. But with mutual funds, in and out, let me tell you, at times people bring the money after 1 week, they come for it. Things happen. So anytime you can always come for the money. But we encourage that if it's an investment, to get the best of benefits, at least keep it for a year. But we know things can happen. There could be emergencies. You can always come for the money, but would encourage that if you want to get the best of the investment, it should stay for a while so that at least you tend to benefit from the gains.
Yeah. But are you charged for, let's say, monthly withdrawals?
No, you're not charged. When you come, then that's where it would have happened if there was exit fees.
Okay.
Fund has no exit fees. When you come, you pay and then you take the money. But like I said, you benefit for future or potential opportunities that may come. But if there are no exit fees, you are not charged. But if the fund says that there are exit fees, then you need to be a bit mindful and know that you may be charged for that. So always watch your prospectus so that it's not there.
All right. I think this will be our last question. And it's a question for Fidelity. So he said, how can I track my investment growth on a daily or weekly or monthly basis? Is there a statement that is sent or a USSD code that I can check the progress or the growth of my investment?
Okay. I think for now, how you check it is there on a monthly basis. Yeah, so we send reports to all the clients on a monthly basis. There's a move to weekly and then daily as well. The integration is ongoing. It's not done. So now it's monthly. We send monthly reports to our clients just to know that, how well the investments are doing and then how you can top up to even earn more returns as well.
Okay. We have this too. It's about bonds, but maybe you can address it for the person.
Okay.
Person wants to know, is it possible to sell a zero coupon bond, which has a 5-year maturity and semi-annual principal payments? I don't really understand the question.
Oh, I wish that maybe I'll let you engage. You can buy instruments. I just need to know what kind of instrument it is. You need to sell, but you need to know what kind of instrument. But like I said, we'll link you up with brokers at Treasury, and then they can have a conversation with you. They trade in bonds, securities. They are very deep when it comes to the financial markets. So we can link you up with our Treasury, and then they will help you do trading. I'm a fund manager. The bank has a very strong trading team to our Treasury who can assist. So it's not a problem at all. Once I contacted them, both the bank and us as well, once you engage them, anything is, we can help.
Okay. All right. Okay, one final one.
Okay.
Neo wants to know, why is Blackstar Advisors Fixed Income Alpha Plus Fund outperforming all the other fixed income trusts in Ghana and by a huge margin?
I think that as a stand of respect, I wouldn't want to comment on that. But the regulator is currently looking at harmonizing how we all calculate returns. So I think that over time, it's only a third party that can do that and then vet it. So I think I'll leave that to, it would be unfair to say that, they are doing this, but I think that would be unfair. So as a sign of respect, I'll say that including my returns, Blackstar returns, once a third party vets it, then at least we are all very much comfortable. So I won't be in a position to tell you why the returns are that way. I think it's properly leave it, and then hopefully because our regulator is saying that these are some of the things they are doing, ensuring that we have all these systems in place. The third party institutions will actually do this valuation of funds, and then they can then come and say, well, we've gone through the process. We are all using the same, there are different methodologies. We're all using the same methodology and then coming out these returns. So I think that that's what I can see on this particular one. Yeah.
Okay. Thank you very much, Mr. Boahene. Do you have any final words for us before we end the meeting?
Well, the question will be, when can I start investing? The time is now. Whether you want to do bonds, whether you want to do mutual funds, let us start now so that at least we can all enjoy a comfortable retirement. We can all support our community, support our family, and then enjoy life in our later years. Let's make sure our money today can travel well into the future, any returns and beat inflation and all that. So that's what I'll say. The time to invest is now.
Okay. Thank you very much. So viewers, you can contact Mr. Boahene and his people at Fidelity later. We will send the presentation and their details are in the document, so you can do that. Before we leave, we have another webinar scheduled for 29th of August. So we hope to see you there on the 29th. We'll be meeting. We'll try as much as possible to correct a few of the problems that we had during this presentation. But we appreciate you joining us tonight. And thank you, Mr. Boahene, for making time to teach us about how to choose a mutual fund. So we'll end here and then we'll see you again on the 29th.
Thank you very much.
Have a good night, everyone, and we'll see you later. Bye.
Okay, thank you. Bye. Thank you.
So we'll end here and then we'll see you again on the 29th.